What if you could find the next big growth stock, but without paying a ridiculously high price for it? Well, today we're going to break down the strategy of the market legend Peter Lynch, who did exactly that. We're going to look at his blueprint for finding incredible companies at prices that were surprisingly down to earth.
You know, almost every investor starts out facing this classic dilemma. On one hand, you've got growth investing. You're chasing those rocket ships, right? The companies with explosive potential, but also a very real risk of crashing and burning. On the other hand, there's value investing. You're hunting for bargains, looking for that margin of safety, but you might be waiting a long time for them to take off. It's this constant tug of war between high speed and high security.
Okay, but what if that whole dilemma is just a false choice? What if there was a way to get all the thrilling upside of growth, but with the safety net of value investing built right in?
Well, that is the exact puzzle that the legendary Peter Lynch cracked. When he was running the Fidelity Magellan Fund back from 1977 to 1990, he just flat out refused to pick a side. Instead, he came up with this brilliant hybrid approach that pretty much rewrote the investing rulebook.
So, you're probably wondering, just how well did this new approach actually work? Well, the proof is in this one. Absolutely staggering number. For 13 years straight, Lynch delivered an average annual return of 29.2%. Just let that sink in for a second. That's not just a good number, it is truly legendary.
And to really put that into perspective, just take a look at this. During that same time, the S&P 500 was having an amazing run of its own, averaging a really impressive 15.8% a year. Lynch's fund almost doubled that. This wasn't just beating the market, this was lapping the market, year after year.
And his secret weapon, the whole key to his strategy, was something called growth at a reasonable price. We just call it GARP for short. And the philosophy behind it is just beautifully simple. It's all about finding these fantastic companies with strong, sustainable growth, but, and this is the key, refusing to overpay for them. It's literally the best of both worlds. You get the powerful engine of growth, but with the sensible brakes of valuation.
Okay, so how on earth did he actually find these gems? While a lot of his best ideas started with just simple, everyday observations, he always put them to the test with a really disciplined set of numbers. So let's pull back the curtain and look at the core metrics he used to separate the real winners from the wannabes. All right, now Lynch had a favorite tool in his toolkit, and it was the PEG ratio. Now, most of us know the PE ratio, right? It just compares the company's stock price to its earnings. But Lynch added this one crucial extra layer. He divided that PE ratio by how fast the company's earnings were actually growing. This one simple tweak gives you an instant snapshot of whether the stock's price is actually justified by its growth.
So for Lynch, there was a magic number here, and that number was 1.0 or even less. See, a PEG ratio of exactly 1 means the price is perfectly in line with the growth. It's fair. But if you could find a stock with a PEG ratio under 1, whoa, that was the signal. That suggested you might be getting all of that incredible growth at a bargain price. It's such a simple and powerful indicator.
But, the PEG ratio? That was really just the first checkpoint. As you can see right here, he put stocks through a whole checklist. He looked for strong, steady earnings per share growth somewhere in that sweet spot of 15 to 30%. And this is so important. He demanded a healthy balance sheet. A low debt ratio, under 25%, meant the company wasn't overleveraged and could survive a downturn. A stock had to check all these boxes to even be considered.
But here's the thing. Lynch's real genius, his secret sauce, wasn't just about crunching numbers. His true competitive edge came from the other side of the coin, the qualitative stuff. It was a mix of good old-fashioned, on-the-ground research and a brilliant way of understanding a company's actual story.
It all comes down to his most famous piece of advice, something you've probably heard before: invest in what you know. What he was saying is that you, the regular person, actually have an advantage over the pros on Wall Street. Just by paying attention in your daily life to the stores you shop at, the products you love, you can spot amazing business trends long before they show up in an analyst's report.
Now, this is absolutely crucial, and it's where a lot of people get them wrong. Invest in what you know was never the end of the story. It was the starting point. It was the spark. Seeing a new restaurant with a line out the door was the hypothesis. The real work came next. You still had to go back and prove that story with the hard numbers we just talked about.
See, Lynch was also brilliant because he understood that not all stocks are created equal. He sorted companies into these 6 basic categories, and this was so smart because you can't evaluate a slow and steady utility company, a slow grower, using the same ruler you use for a risky turnaround that's trying to come back from the brink. A giant, reliable stalwart is a totally different beast than a small, explosive, fast grower. Each category has its own story and its own rules.
All right, theory is great, but let's see how this all works in the real world. Let's look at a classic case study of how Lynch combined his street smarts with his number crunching to find what he famously called a 10-bagger. That's a stock that goes up 10 times your initial investment.
A perfect example is his investment in Taco Bell. It all started with that simple observation. He was out in California, saw how popular they were, and then started noticing them popping up back east. That was the invest in what you know spark. Then came the numbers. He dug in and confirmed they had explosive growth. But the real kicker? The company had 0 debt. It was a growth machine that was also financially bulletproof. The result? A massive 10-bagger, a huge home run for the Magellan Fund.
Okay, so that was then. The big question is, does any of this still apply today, in our world of high-speed trading and instant information? The answer is absolutely yes. But the nature of where you find your edge has definitely shifted.
The game has changed a little bit. Back in Lynch's day, just finding a company with a low PEG ratio required hours of digging through financial reports. Today, you can run a stock screener and get a list in 5 seconds. So the real advantage, the place you can still outperform, has moved. It's less about finding the numbers and more about doing that deep qualitative research to understand the story behind the numbers better than the rest of the market.
And really, that brings us full circle, right back to Lynch's most powerful idea. His blueprint empowers all of us to just look at the world around us a little differently. So the real question to leave you with is this: what future 10-bagger is hiding in plain sight in your daily life? The answer could be at your favorite coffee shop, in the software your company just started using, or in that new product you and all your friends suddenly can't live without.